Everything is overbought right now. We are seeing mass amounts of debt in the system, and it's not looking good in the short term. Let's take a look. The stock market has seen a run up that seems like it can't be stopped. It rings a bell for those who are keeping tabs. 1 year ago, it was very similar and ended with the VIX disaster, with the Federal Reserve being very cautious to even suggest another rate hike is coming. The markets have every reason to rise, and they most certainly are. But what will happen in the near future? You came here for the truth, so let me unveil that for you. Today, we're going to look at several economic indicators. We must always be staying ahead of the game and understand what's happening before it actually does. And we do so by paying attention. The market is always giving signals, and these have repeated patterns over and over again. There are those who pay attention to the technical analysis, and then there are most individuals out there that simply don't know what the hell is going on, but they bought into something and it has risen ever since, and that's their strategy. But of course, that isn't much of a strategy at all. So I like to take from every single possible angle. I see the technical analysis, I see what the Federal Reserve is doing, I see the geopolitical aspects. I take bits and pieces from all of these sources, mainstream media, government statistics, white papers that we're looking at, all different types, and I piece it together, and I have some information to bring to you today that will add to that. So let's begin. Today in the markets, they were down in the red just a little bit, and this came after several days of non-stop growth. And that's what's been happening right now in the markets. They look like they're heading towards their previous highs. Right now, I'm showing you the one-day chart on the S&P 500, but if I pull back to the 1-month chart, you could see it's a straight line upwards for the most part. If you look at that 3-month, things start to look a little different. Pulling back to the 6-month, you get that other picture there. And essentially what we have over the last year is we're about the same place we were a year ago. All throughout 2018, things were looking bad. It started from the VIX, then we had some recovery, and then of course we had October to December looking very terrible. But this is all because of some earnings that were taking place not so good. There was a little bit of fear out there because of this company or that company. I'll show you a little bits and pieces right now, but I wanted to give you the technical analysis on how overbought things are today. Now, while Bloomberg is a little more shy with their words than I am, they used the everything rally and I would say the everything bubble. But stocks, bonds, oil, and gold touched overbought on Wednesday. So you could see the RSI, the relative strength index, on the 14-day as of February 20th. And you can see all of these different factors have pushed themselves into overbought territory. Now, what about the longer term trend? Well, that doesn't apply to this. We are looking specifically on the short term. In relationships you see between the Brent crude oil, for example, which had fallen down significantly, it pushed up higher. In a short period of time, it looks like it is a little bit overbought, but the price is still far lower than where it was a decade ago. You look at something like the S&P 500, which has gone ballistic over the last month. That's a different situation than I would say with gold, because we've seen it subdued for such a long period, and then it had come up in percentage terms. While it might be higher than where it was previously, it has been trading within a range for years. So the RSI is only valid for this short period of time. So don't be confused about is a stock or is a bond or is a particular asset overvalued based on the RSI. It's really just for technical analysis on the short term. When you're looking at that, I wanted to make that very clear. And then we're looking at basically the same situation. Everything is overbought. We're looking at the RSI covering the same assets. I just wanted to show you in the chart form here to give you an idea of where it happened to be. And you could see from October all the way through, it basically has exploded higher, and that just gives you an idea of where it has gone in chart form as well. I always wanted to show in as many different ways as possible. Kraft Heinz slashes its dividend, discloses SEC subpoena stock tank. banks. I wanted to show this to you because there are several stocks right now as I record this video that have reported terrible earnings. In this case here, they slashed their dividend, and this is worrisome to me. When they slash their dividend, they are doing so in order to keep money within their borders basically, and that's not really good for people looking to invest in this company, because if it was me, I would buy a stock based on its dividend being one primary factor, because I want passive income. That's the reason why I do any form of investing. I want to put something in and I want to get something out on a monthly basis. If I'm not getting something out on a monthly basis, there's probably no way I'm going to put my money into it. That's just the way it is. If you're going to invest in a business, if you're going to invest in a stock or some sort of paper asset or real estate, you need to be cash flow positive. That's the whole point of it. If you're waiting for appreciation, that's a big mistake. That's called speculation. That's a whole different topic for a different video. But we're looking at one stock that has done this. This isn't the first time, of course. You can look back in history, look even just to the last crisis and what many companies did. They encountered some problems throughout the financial crisis and they slashed their dividend way down. They do so for obvious reasons, and the shareholders that are in there, think about it. You're not getting any appreciation. Your stock has come down, so the value of your portfolio has fallen, and now you're not even getting money on that quarterly basis in this case here. So that couldn't be a good thing for people in the long term. Of course, that needs to be reversed and they need to increase their dividend, and that shows the strength over time. We'll see what happens. I'm not even pointing at Kraft Heinz. I'm just showing you this as an example of what we're seeing right now. Fed's bullet, rate hikes, balance sheet reduction coming to an end. So this is one of the most bullish, or as they like to call it, hawkish of the Fed. And he actually says it in here. I am not necessarily in the same camp as many of the others, or in fact, most of the others. But he said that basically what we talked about in a previous video, the central bank officials say a timeline to be finalized in the next couple months. So that's going to be when they will decide to tell the public about reducing. No, that's not going to mean that in a few months from now they're going to stop reducing altogether, unless something crazy changes. If we still have the stock market doing well as it is, then of course we can have this play out as they plan to, but who knows, if something changes, sure, that can make a difference. Bad news for Australia here. The indefinite ban on imports from top supplier Australia, effective since the start of February, comes as major ports elsewhere in China prolong clearing times for Australian coal to at least 40 days. There is an important partnership between Australia and China. I have always told my friends in Australia, if you want to know what's going to happen to your economy, look to China. It is extremely important that they are doing business together, because China needs to consume, Australia can produce, and the money can go there. You also have many individuals in China who purchase real estate in Australia that helps to support the bubble that's there, which is now deflating, of course. But either way, when I look at this, it is not good for that partnership. So there's more to this. I don't want to get into much of the details here, but I just wanted to show you that there are tensions that are rising, not just between China and the US, but also between Australia and China as well. I'll leave the link in the description if you're interested in that. There are deficits not just between countries that trade, it is also within the country's borders themselves. You can see how the debt escalates, the deficits get worse, and here is one example. On our current path, annual deficits will hit $2 trillion annually in a decade, according to the CBO. The debt will grow to 148% of GDP from today's 78%. Debt service will consume $1 trillion a year of the federal budget. They tell us that everything is just fine. They tell us that the interest payments are nothing to worry about, but we are going to see $1 trillion a year specifically there to pay the interest on the debt that shouldn't even exist. What a crazy system that they've conjured up. But they somehow have convinced the public that the system they built is the reason why everything functions the way it does. The sun comes up in the morning because of the Federal Reserve. You get tucked into bed at night and you have those sweet dreams. That's because of the Fed. You want to know why the grass is green? It's because of the Fed. I think you get the picture. More debt, this time in Japan. Japanese banks might have snapped up a third of the loans made to highly indebted US companies, propelling the size of the market past $1 trillion. That's according to UBS. Years of low yield spurred investors to pour money into leveraged loans, credit extended to companies with the weakest balance sheets. Such assets were pitched as a haven for those worried about the prospect of rising interest rates and were often repackaged, you know that I talk about this all the time, into so-called collateralized loan obligations, or CLOs, with credit enhancements to protect investors. I talk about all the different derivatives. I talk about the CDOs, the CDO squared, the CDO cubed. I talk about the asset-backed securities, talking about all of these different derivative packages that have been created. I talked about them in both of my books. I have them basically scattered throughout the 2,100 plus videos I've done on this channel. And my goodness, we are entering into new territory. The CLO has become the new CDO. Of course, the problem isn't the same size when you look at the actual total quantity, but that doesn't matter. It's the way that derivatives work. I've already harped on that so many times before. I'm moving on. Now the worry is that cracks are beginning to develop in what was once one of the hottest products on Wall Street. A record $2.5 billion was yanked out of leveraged loan funds in the week ending December 12th. And of course, don't forget that these are rated AAA. Can you believe it? Once again, they did this. They tell everybody, and they really truly get away with it because of how ignorant people are. We saw the problems last time around with rating the worst garbage you can possibly imagine, AAA. Everybody made fun of it. They made books about it. They made movies about it, and investors laughed and said, how could we have been so stupid? Well, guess what? They're doing it again. AAA rated garbage. And why are they investing in it? Well, it's pretty obvious. They have higher yields than like-rated sovereign debt. Of course, people, that's what they need right now. They need to get that money. They need the profit, so they put it into riskier and riskier assets. Not that I would call this an asset, but that's what they do. Very quickly, just want to touch on this. Basically, we're looking at the Federal Reserve in this case here, and I don't want to get into what the article talks about, but essentially they're backed into a corner right now. They are trapped. They are at a point where they're trying to make it as easy as possible for these markets, and yet there's still some resistance. There's still some pressure here. The S&P is unable to get past 2,800 despite the, quote, dovishness of the Federal Reserve, despite the fact that they have still $4 trillion on their balance sheet, despite all of the stimulus, everything they've done. There's still resistance, and they are basically put into the corner. What are they going to do? Are they going to reduce interest rates? Are they going to print more money? That's where they're at right now. And I just wanted to include this at the end. I really need to touch on this point, and it's very telling because you can see the difference in between a regular investor and somebody like a Warren Buffett. Not necessarily him, but just look at this. Warren Buffett never buys or sells stocks using this common method. He basically said, never use a stop loss. And that's the difference between Warren Buffett and the average person, because Warren Buffett knows in advance if a stock is ever worthy of getting into. I'm sure he's gonna get the little tip if something's gonna go wrong. He's gonna sell off his shares. He's gonna be notified, and guess what? You are not. And as I have described previously, and I'm sure most of you already know, you get the information that Warren Buffett or any other big investor like this has sold a stock well after the event. Okay, so you're looking at a minimum of 6 weeks after, up to 3 months, okay, depending on when they release their 13F and you actually receive that information. So you're not going to be able to be aware once they sell. Sure, you could see the stock drops, but you won't know what happened until later on. This here just tells you that you cannot rely on the same things that the big guys are doing. Now, if they give something out to the public and they specifically mention what they've done or anything, but you can't really trust that necessarily, though people would find out as soon as those 13Fs hit the public anyway. But I just want to show you that because a lot of people, they think that they're doing and playing the same game as these big boys. They're not even on the same playing field at all, but yet they pretend that they are. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these 2 books have everything that you need, so definitely check them out at the link in the description if you want the audiobook that's available at themoneygps.com. If you haven't seen this video already, you definitely want to check it out. A lot more information that I cover in here that I could not on this video, so definitely click on that, and I'll see you there.